Hello and welcome to Commercial Pace, filling gaps in the capital stack. My name is Joshua Kagan and I'm the Managing Director at CleanFund. I want to thank our media partner, Connect Media, and our developer partner, EKN Development Group, for their support on today's webinar. These slides are going to be made available after today's webinar, so no need to frantically screen grab. Additionally, we want this webinar to be as interactive as possible, so feel free to type in a question and we will do our best to get to it at the end. Note that I will be using the moniker CPACE to stand for PACE today. The C is in reference to commercial PACE. So my goals for this webinar are threefold. The first is for you to walk away with an understanding of where PACE fits into a development or redevelopment capital stack. The second is for you to walk away understanding how PACE can improve a project's weighted average cost of capital by 100 to 200 basis points, increasing project returns by potentially millions of dollars. And third, for you to understand the specific steps involved in identifying a PACE opportunity and closing the project. So with that, I will move to our agenda, which is we will quickly go through some introductions, followed by an explanation of what CPACE is and where it fits in the capital stack. We'll go over a couple real-world applications of CPACE improving project returns. We'll walk through the steps in identifying and closing a PACE project, and then we'll move to your questions. So for brief introduction, as I said earlier, my name is Joshua Kagan, and I'm Managing Director at CleanFund. I work with owners, sponsors, developers to structure accretive PACE transactions. I've been a CleanFund for 4 years. I came in as employee number 6, and I've closed more than a dozen deals. Previous to this, I ran the Global Energy Efficiency Finance Division of Richard Branson's Carbon War Room. And previous to that, I was with Atlas Capital, a clean tech venture capital firm. Joining us today as well is Jason Bass, who's the Director of Finance for EKN Group. Jason has spent more than 25 years in commercial real estate. He's a deal guy and an absolute expert when it comes to financial analysis, structuring, and development. So who is CleanFund? CleanFund, we were founded in 2009, and from day one, the only thing we've ever done is commercial PACE. One of our founders, Craig Hill, was the financial advisor to the city of Berkeley when Berkeley created the nation's first PACE program. So deep DNA in PACE. We're a direct lender. We're not a broker. We're the oldest standalone CPACE company, and we've funded more than 80 projects, which is more than anyone in the country. A couple months ago, we did the industry's first 144A securitization of $120 million of our projects that we funded in the last year or so. As I said, we're a direct lender. We're backed by a very large private equity company, a large insurance company, and a large asset management company. So what problems does CPACE solve? Well, our clients are telling us that we are in the later stages of the cycle right now, and projects are experiencing labor cost increases and material cost increases, and there's cost overruns. And senior lenders are unwilling to provide more debt than what was perhaps originally prescribed. And so our clients are faced with having to raise pref equity, which can cost in the high teens or low 20s, or mezz, which can be somewhere in the sort of 9 to 15% range. Our clients are also telling us that allocations for things like EB5 and new market tax credits are either drying up or being delayed. So there's gaps in the capital stack that need to be filled. And that's perhaps where PACE can come in. So what is CPACE and how does it potentially address these problems? So CPACE stands for Commercial Property Assessed Clean Energy. It's a financing mechanism that enables a borrower to source capital. And in return for this capital for energy efficiency, water efficiency, renewable energy, or in California, seismic projects, and in Florida, storm resiliency projects. And in return for this capital, our clients agree to put a special assessment on their property taxes. I should say that many of our clients aren't trying to create the world's greenest buildings and ask us, well, will they still qualify for PACE? And it's very likely that in a development project, you're going to spend dollars on PACE eligible items, whether you're aware of it or not, things like windows and lights and the roof and mechanical equipment. I'll kind of go into that a bit later. So as I said earlier, our repayment occurs from a property assessment. And This isn't actually really anything new. For 100 years in our country, we've been using property assessments to pay for infrastructure, whether it's things like paving the sidewalk or the local fire department building or the local public school or mosquito abatement. PACE is just another assessment that gets recorded on the property tax. There's a couple innovations here that kind of make it interesting from a financing perspective. The first is if our clients ever sell their buildings, they never have to repay us because the obligation stays with the property tax. The second is if our clients have triple net leases, they can potentially pass this assessment on to their tenants. And some of our hospitality clients have come to the conclusion that since PACE is repaid from property taxes, that they can put a line item on the checkout bill of their lodgers that says energy assessment tax and pass some of the PACE repayment onto their lodgers. A third innovation is that since this is repayment from property taxes, this is a very secure form of lending for CleanFund. And we can do things that traditional lenders can't do, like 30-year terms that are fixed rate and fully non-recourse. So where does PACE exist? PACE has to be enabled at the state level. A state government has to create enabling legislation, and then counties and cities opt into it. Thus far, 35 states in the District of Columbia have passed enabling legislation, and 20 states have up and running programs. I should say that PACE is rolling out across the whole country. So in the last couple months, Delaware, Pennsylvania, Illinois, Nevada, et cetera, have all passed enabling legislation. In the coming months, we expect New Jersey to pass it. In 2019, we expect Chicago, Manhattan, Massachusetts, et cetera, to launch their PACE programs. So what is PACE eligible? What type of assets are eligible, and what are the measures that are eligible? So in general, CleanFund can finance any type of commercial building, and it's hotels, it's office, retail, it's kind of the main food groups as well as kind of more specialty assets. What we can't finance is government buildings, and the reason being that governments don't pay property taxes. We can do multifamily as long as it's 5 units or more. We can't do buildings that have major environmental issues like a gas station or a mine. So what are the eligible improvements? Well, as I alluded to earlier, the buckets are energy efficiency, water efficiency, renewable energy, storm strengthening in Florida, seismic retrofits in California and Portland. So energy efficiency could be lights, windows, envelope, insulation, mechanical equipment, electrical equipment, elevators, roof, etc. Water efficiency could relate to pumps, low flow fixtures, irrigation, renewables, solar, storage, etc. And we can help you go through a budget and identify what might be PACE eligible, but I'll come to that later. So when should owners or developers consider CPACE? Well, there's a lot of different applications for our capital. One of them could be a simple retrofit. For instance, we closed a project last month in Denver at the Petroleum Building, which is in downtown Denver, and our client was facing end of life of $1 million of a chiller that needed $1 million to replace it with a new one, and that was a simple retrofit that we were able to finance. We do value add acquisition projects. For instance, we closed a project a couple years ago in San Francisco with Cypress developers where it's called 644 Broadway, where our client was taking a 3-story office building and transforming it into basically the Chinese food version of Italy. It's called the China Live building now. Our capital is being used for tenant improvement projects, as well as for new construction and redevelopment. And we're going to go into a couple case studies around that. And with that, I will turn it over to Jason Bass.
Thank you, Joshua, and I appreciate the opportunity to speak today. We just closed on our first PACE loan. Now I think it's been about a month, a little over a month, in Rochester, Minnesota by the Mayo Clinic. Very excited about the prospects for PACE and are looking at several of our other development deals to do CPACE financing with CleanFund. The Holiday Inn project specifically in Rochester is the one that I'm going to speak to today. Again, we closed a $2.5 million CPACE loan on that deal. We acquired the property back in March of this year. It's pretty pretty run down, tired Holiday Inn, 173 rooms. And we are in the process of converting that hotel to a Hotel Indigo. We closed the doors of the property in early September of this year, and we're looking at about a 10-month timeline to get to the doors open for the Indigo. The pace really came in handy on this deal. It was a complicated deal. The hotel itself is within a larger HOA in the building. There's some residences above the hotel. There's some ground floor office occupancies that are separate from the hotel. And there were a lot of issues with the building in terms of the energy efficiency, in terms of the various systems, et cetera. So there were a lot of elements that are coming into play with the redevelopment associated with energy efficiency, water efficiency, et cetera. And trying to get the right leverage with our senior lender was proving very tricky. So being able to layer behind, well, technically in front of, but effectively behind that senior loan, that $2.5 million CPACE financing really made the economics on the deal pop for us, and took a lot of pressure off of us on the equity side. So everything that Joshua said earlier in terms of how PACE can be used to bring down your weighted cost of capital, how PACE can be used to avoid expensive, pref equity or mezz debt that often is really hard to work with the senior lender on. PACE is a nice non-recourse, vehicle. And the beauty of it being on the property tax bill is that the senior lender does not give up any kind of subordination. So the senior lender remains in a senior position, even though effectively the PACE loan is paid out of the property tax bill as part of your, through your assessment. The PACE lender, in this case CleanFund, doesn't have any direct ability or claim to attach to the property if for non-payment of the property tax bill. It can only make a claim on the current property tax bill. So education of senior lenders, I know, has proven a process, and now there are a lot of senior lenders out there who understand PACE and are comfortable with bringing it in because they don't feel that it puts them in a subordinate position. But it was a great process working with CleanFund, going through all the elements. There's a lot to know about each state's specific PACE legislation and rules. That's something that I learned going through the process. Minnesota has its own set of regs and processes. California has very different ones. So it's very important as the borrower to work very closely with CleanFund and really understand the nuances on a state-by-state basis. We have projects in California, Minnesota, up in Washington State. We're actually exploring a project in Alaska now, and they just approved CPACE about a year ago, and we're trying to figure out how we do it there as well. But so far, I haven't really seen any issues or challenges with bringing the financing in, and it's a great way, especially in this challenging senior lending environment, to really increase leverage in a very constructive way and on a non-recourse basis. So it's been great.
Thank you so much, Jason. Really appreciate the overview and your partnership. It's been awesome working with you, and looking forward to doing more projects together.
Absolutely.
Great. So I'm going to turn it over to one other quick project because I think this also exemplifies the power of PACE. It's a different application of PACE. On this one, our client, Altura International, they purchased an old historic warehouse building in Dallas, and it was a 500,000 square foot building, and they wanted to reposition it into 270 key hotel and 250 apartments. And they needed $120 million of capital. And it was kind of a complicated capital stack. There was debt, equity, mezz, historic tax credits, new markets tax credits, EB5. I'm sure some of you on this call have done these kind of deals before. And we looked through the construction budget, and we were able to find $24 million of PACE eligible items, the windows, the roof, the LEDs, et cetera. And we were able to write a check for $24 million at 6.15% repaid over 20 years. And the result of that is we took out 15% mezz money. And in doing so, we brought our clients' weighted average cost of capital from 9.3% to 7.46%. We brought it down 160 basis points, and is going to literally save our client more than $1 million a year. This is the power of PACE right here. So you might be asking yourself, well, how do I determine if my project will qualify for PACE? And the way to do it is, it's pretty simple. Send me an email, joshua.kagan@CleanFund, with the following information. Let us know the property address so we can determine, is it in a PACE eligible area, or is PACE going to be there in the coming months? We have relationships with every single PACE program administrator in the United States, and we have a good sense of where PACE is being adopted. And as I said earlier, it's rolling out across the whole country. Let us know, is it a new construction or a retrofit project? What kind of asset class is it? What are your sources and uses and a construction budget? And what you think the value at completion is. From there, we'll turn around with a term sheet. And assuming we come to agreement on terms, we will move to an LOI. So upon execution of the LOI, what are the steps to closing? Well, it's pretty simple. There's pretty much 3 steps. The first is we're going to work with the construction lender to get their consent. Jason alluded to this step. Since PACE is an assessment, we are repaid from property taxes. And one implication is that in a workout situation, property taxes get paid ahead of debt. And by statute, we have to get the consent of the senior lender. And many of you might have heard that this is a challenge with working with PACE. And this topic is an important one. And I'm going to address it in more detail in a few slides around the specific mechanics of how we get consent and why we're getting consent as often as we are. So just hold that for now, but know that as soon as we issue an LOI, our next step is to get lender consent. We're going to get CPACE program approval. And I should say that there's these PACE administrators who are there, who are an outsourced function of the government. They're there to prevent abuses. They're there to make sure that we're financing, windows and lights, not tables and rugs. And again, we have a great relationship with all of them around the country. We know how to do it. The third thing we do is we underwrite the transaction, and we understand that we're repaid from property taxes, and that's what we need to underwrite to. So we need to underwrite to the property, and we're less concerned about the net worth of our borrowers and more about the fundamentals of the actual property. And then we close. And closing consists of our funds being wired into an escrow account and getting dispersed based upon milestone payments, usually pari passu with the senior lender. I should say, up front that PACE dollars can only be used on PACE eligible items. And those items tend to occur when after a building's finished its horizontal work and it's gone vertical. So things like, the windows and the lights and the envelope, et cetera. What are our typical terms? We can, our sort of strike zone is somewhere between 500,000 and 200 million. We can go below 500,000, although those projects tend to get expensive for our borrowers because of some of the fixed fees involved. And we can go above 200 million, although 200 million is the largest term sheet we've ever put out. Our terms are 10 to 30 years, fixed rate, fully non-recourse. There's no covenants or guarantees required at all. We can do, in general, 20% of the as complete value, which tends to correspond to 20% of the soft and hard costs. And we can do a combined 95% PACE plus debt lien to value. Although on a new construction project, senior lenders aren't going to go up to 95%. The maximum I think we've seen is 80% combined lien to value. We really look at ourselves as the quarterback of the PACE process. We're here to make this simple, easy, and efficient for everyone involved. And that's why we like to handle the lender consent process as well as the PACE program approval process. So as I mentioned earlier, getting lender consent is one of the steps in the process. So you might ask yourself, how will my lender view PACE? And the reality is that PACE is an assessment. It's an assessment that gets repaid from property taxes. And like any other assessment, and this is a very, very important point. If there's kind of one thing to take away from this webinar, it might be this. And that is PACE, like any other assessment that goes on a property tax bill for 30 years or 50 years or even 70 years, in a workout situation, under no circumstances can accelerate. The amount that's ever ahead of the senior debt is really this year's property taxes. So consent ultimately comes down to the project-specific cash flows, NOI, and debt service coverage, once the lender understands that CPACE does not accelerate. So I'll give you an example. we're working on a project in the Bay Area right now. It's a very large multifamily project. And our client needs $180 million of capital. They have a lender who's going to give $110 million of debt, which is like 61% LTV. They wanted $30 million of PACE. Without PACE, their current debt service coverage is a 1.53. With 30 million of PACE, it brought down the debt service coverage below 1. And the senior lender said they won't go below 1.2. So we right-sized the project and got it down to 20 million, which has brought the combined lien to value, PACE plus debt to value to 72%. So we worked with the lender to get them comfortable and right-sized it from 30 million to 20 million. And replacing 20 million of pref equity with a 20% return threshold with 6.25% PACE is going to save our client more than $2 million a year. So occasionally our clients come across borrowers who are lenders who are completely obstinate or ideologically opposed to PACE. That happens, and that can happen. And that's why it's my pleasure today to announce for the first time the launch of CleanFund's Debt Capital Markets Group. We're the only CPACE team with full-time employees actively partnering with PACE-friendly lenders. It should be noted that 2 of CleanFund's largest investors are 2 of the 7 largest construction lenders in the United States. And we have an active network of local, regional, and national lenders who we're bringing deals to. So if you come across a lender who seems just completely difficult to work with, let us help you find one who is more PACE friendly. So in conclusion, CleanFund, we were founded in 2009. We funded more commercial PACE projects than anyone in the country. We had 40% market share in 2017. Our financial technology, CPACE, can replace pref equity, mezz, or expensive debt if you give debt from a debt fund in the capital stack. And in doing so, we can improve WACC, or weighted average cost of capital, and sponsor returns by between 100 and 200 basis points, and potentially increasing your returns by millions of dollars. And with that, I will turn it over to your questions. And I see that there are some questions that have already been posted. And if you have questions, feel free to type them in. And the first question asks, you mentioned you can't do PACE on government buildings. So how can you do PACE on other tax-exempt entities? So how does a hospital who's a tax-exempt pay this? So how does this occur? And this individual might be referencing the Seton Medical project we did, Seton Medical Center project we did last year, which was the largest project in PACE history. It was a $40 million seismic retrofit of a hospital in San Bruno, California. So you're right, governments don't pay property taxes. They can't qualify for PACE. But not-for-profits, they don't pay property taxes, but they can and are able to pay property assessments. So that's how we're able to do hospitals and community centers and all kinds of other not-for-profits. Another question is, does CPACE only work when the capital stack is being reset, as in new construction or acquisition financing, or do you have success working with existing lenders? So we absolutely, PACE can be used for stabilized assets as well as for new construction. And we have a great track record of getting consent from existing lenders. There's a number of reasons why lenders give consent. They want to maintain good relationships. Existing lenders want to maintain good relationships with their borrowers. Oftentimes on a retrofit project, we're bringing down operating costs. We're reducing, with PACE, we're reducing energy costs and potentially maintenance costs, which can offset the increased payment. That's clearly the case on a lot of the solar projects we're working on. So great record in terms of getting the consent of existing mortgage holders. One challenge is around CMBS servicers. Although we have gotten consent from LNR and CW and some others, there's just a lot of time and energy that goes into finding the right servicer and explaining to them, and et cetera. So those tend to be more of a challenge than bank lenders or private lenders or things like that. Let's see. Another question. How do you work with finance brokers? We work with brokers every day. And there's a lot of ways we can work with them. We can, honor fees, brokerage fees that are in place, et cetera. So why don't you contact me afterwards and we can go in more granularity. All right, a lot of questions coming in at once. So let me just pause. So one question, is prepayment allowed, and if so, under what terms? Partial and full prepayment is allowed at any time, and it's a percentage of outstanding principal. I should say that our terms are flexible and intended to match the business plan of our clients. So for instance, if our clients are planning on selling their asset upon stabilization, we can get aggressive on prepay in return for a slight increase in rate. Let's see, what other questions? Where do opportunity zones fit in? So I should say that we've done deals, the Dallas Butler project is an example where we've done deals out of EB5 and new market tax credits and historic tax credits. And we've invested in the largest credit team in the industry. So they probably don't want me to say this, but highly structured deals are our specialty. And additionally, with opportunity zone projects, those have a requirement around substantial renovation and rehabilitation. And PACE can be a great tool for paying for this rehab, especially if the assessment can be passed on the tenants, because then the true cost of capital gets close to zero. So what is the typical timing start to finish? That question. Okay. So in general, as I said earlier, the steps to closing a project is, we issue a letter of intent once we've kind of scoped, gone through the construction budget and determined what's PACE eligible and have agreed to terms. We issue the LOI, we get consent, we get PACE program approval, and we underwrite. Typically it's 45 to 90 days. Yeah, it's sort of dependent upon what our client's relationship is with the borrower and how much education is, with the senior lender and how much education is required to get it involved, to get them consent. Sorry, I'm reading another question that just popped up.
Hey, Josh, this is
Yes.
Jason, real quick. One thing to bring up is, as part of that borrowing process, is the energy assessment that needs to be performed. That proved to be kind of the big work piece of the process for us. All the rest of it was just administrative and, papering the deal like a typical loan. But we did have to do that energy assessment analysis, and we'll have to for our other projects in order to demonstrate the payback. So that may be something you want to mention. Yeah,
that's a great point, Jason. Thank you for bringing that up. That's really kind of a state-specific requirement. So for instance, Minnesota, Missouri, Colorado, Texas have requirements of savings to investment ratio. And that's part of the process around, after we get consent, getting PACE program approval, in addition to making sure that we're actually financing qualifying measures. Some states require an energy study, as Jason just alluded to, demonstrating that over the life of the assessment that there's going to be energy savings involved. And we help quarterback that process as well and work with your engineers to make that happen. Let's see, what other questions are arising? What is the typical percentage of new construction costs that are eligible for PACE? In general, we find that more than 20% of the construction budget is going to qualify, and that we are going to be limited by our own underwriting requirement or statute, depending on which state, around of 20% as complete value or loan to cost. What we do is we'll go through the construction budget, we'll parse out kind of line by line what might be PACE eligible. Another question is, I know each situation is different, but in office buildings, do landlords typically pass PACE payment through their tenants as part of the CAM charges? And, it's really case specific. We definitely have clients who are actively passing them on. We have clients who, it's a conversation with their tenants. We have some who, believe that PACE is assessments are prior property tax bills, and the language of their leases absolutely says that they can pass it on. So it's really project specific, and what is the language in the lease allow for? Another question is, it seems most PACE is for 20 years. Are you going to 25 and 30 years, or is this based on the useful life? So we can do, 10 to 30 years depending upon two things. One, the statute. So for instance, Colorado's statute only allows for 25 years, but in California, we can do 30 years. In Missouri, we can only do 20 years. So sometimes we're handcuffed by the statute. And the other side of it is the effective useful life of the assets we're financing. Another question is, will CleanFund fund solar panel fields or roof installs? We can do ground mount systems. We did a 5 megawatt, $10 million project for Pacific Ethanol, which was a ground mount system. And we are also doing rooftop projects as well. What interest rate would you recommend a developer, use in developing a pro forma? So our rates are tied to treasuries, and we're somewhere, depending upon the size of the project, the asset type, et cetera, we're somewhere between 250 and 400 basis points above treasuries. So, in general, sort of ballpark 6 to 6.5% on a ground up new construction, and less for a fully stabilized asset. And we can kind of talk more specifics once we understand a little bit better about your project. So we are now at 10:31. So we've gone over, and I want to thank everyone for participating. If you've asked questions that haven't been answered, please feel free to follow up, and I will answer them directly. I want to thank again Connect Media for being our media partner, as well as Jason Bass and EKN Development Group for being awesome development partners. And I hope everyone has a great day, and please follow up. Thank you.